Investors are betting on big AI and see big opportunities in the M&A space, according to the results of a new survey. Good morning, I'm Trinity Chavez, and welcome to NYSE TV Live. Today is Thursday, July 11th, and we are coming to you from the New York Stock Exchange, the epicenter of global financial markets. Earlier today, a new report from Oliver Wyman Forum titled "The New Growth Agenda: How CEOs Are Navigating Emerging Shifts in Geopolitics, Trade, Technology, and People" takes a closer look at how chief executives are more than 100 NYSE-listed companies are focusing on growth opportunities that lie ahead. The report is a think tank of management consultancy firm Oliver Wyman, a business of Marsh McLennan, which trades here at the NYSE under ticker symbol MMC. The forum CEO, John Romeo, will ring the opening bell and open up the U.S. equity markets in less than a half an hour. He is accompanied by CEOs of several NYSE-listed companies participating in a roundtable hosted by the exchange today. And diving into the report, one item that specifically stand out, well, are CEOs that are putting a lot of weight into AI. A whopping 96% of NYSE-listed CEOs surveyed say that they considered AI as an opportunity for their business and not a risk. Meanwhile, nearly half of chief executives are investing in AI to be market leaders across at least one use case, and more than 40% cite a fear of moving too slowly as one of their top concerns. Now, this AI FOMO is a very real phenomenon, especially for large companies with more than $5 billion in revenue. According to the survey, 51% of big company bosses say that they fear being too late to the party. Additionally, 64% of large company chief executives surveyed cite aspirations of becoming a market leader in at least one use case pertaining to AI. Now, it's very clear that many CEOs are investing in AI and don't want to miss out on this technology. But exactly how are they implementing it? Well, when asked to talk about what extent that they are investing in the technology capabilities, more than 90% of CEOs surveyed said that they are investing in AI for operational efficiency and support services. While 87% cited insight generation via analytics, 87% said workforce productivity, and 82% said operational risk reduction. Now, the data also reveals that a majority of CEOs prefer to implement AI on lower risk internal use cases, even as they consider bolder moves ahead. Independent from the survey, one CEO who I recently spoke with, Evan McMillan of GridSpace, is using AI for operational efficiency and support services, but in a way that you might not have seen before. Let's take a look.
GridSpace is a company that makes artificial intelligence software for contact centers.
And why would people want to know about this? How is it beneficial for companies?
Super exciting time for voice AI. My co-founders and I really wanted to work together, and we wanted to solve a really hard everyday problem. This problem of hold times. So we would be on the phone with a bank, with an insurance company, with a healthcare provider for hours just to get some basic account change done or some information from the company. And as we dug into this problem more, we learned that the companies hated actually putting us on hold too. But the problem was a staffing problem. They didn't have enough people to answer the phones, and they didn't have enough people to actually train them to take care of customer problems. That got us thinking, what if a contact center could work more like a website, where you could go to the website and you could solve your problem really quickly. You didn't have to wait in line, and there would never ever be this, problem of, queuing to get to a person that could, take care of your issue.
So you actually have a demo that we can try today, right? Tell me about it.
Yeah, so I made you, Trinity, a virtual receptionist that you can talk to about your upcoming dentist appointment.
Dental Group. My name is Grace. I am a virtual receptionist. How can I help you today?
I would like to make a dentist appointment.
Sure. Let's schedule an appointment for you. What is your name?
Trinity.
Okay. Would you like to come in? The first available appointment we have is tomorrow at 11 o'clock in the morning. Does that work?
Yes.
Okay. For tomorrow at 11 o'clock in the morning. Is that right?
Correct.
Great. You are booked. I have sent you a text message with the details. We're located at 11 Wall Street in Manhattan. Look forward to seeing you.
Thank
Have a great
you.
day.
57 seconds. I timed it. So wow, so we were able to accomplish all of this, avoiding wait times, hold times, just the inconvenience of that all in 57 seconds. And I locked in my dentist appointment.
Just imagine those kinds of AI agents in proactive use cases. I mean, think of all the patients that really need to come in for a mammogram, a colonoscopy, any sort of preventative screening that don't have the opportunity to connect with a doctor because their provider doesn't have enough doctors to call out to them and tell them to come in.
Thanks for joining me on Taking Stock.
Yeah, thank you.
But McMillan is far from alone when it comes to expressing excitement over the potential of AI in the workplace. Steve Hasker, the CEO of Thomson Reuters, which trades here at the NYSE under ticker symbol TRI, recently joined NYSE Head of Corporate Affairs Josh King on the Inside the Ice House podcast. This is what he had to say about the significance of AI in comparison to other revolutionary workplace technologies. Take a look.
You know, in the course of my career, I saw the advent of a PC on every desk. You know, when I first started in public accounting, it was a pen and paper. And then my second year in, all of a sudden we were all given PCs. We then had the internet. We had mobile, social, cloud. In my view, generative AI will be bigger than any one of those in terms of its transformation of the lives of professionals. The ability to have a lot of the sort of early foundational, often mundane, repetitive work performed by machines and automated, and allow the human beings and the professionals, the practitioners, to apply their judgment and their networks and relationships. You don't have to spend long with those with those models to know that it's going to change professional work. You know, it's going to change the nature of research, the nature of drafting, the nature of sort of document analysis, and therefore the top of the house within our customers, I think, sees and recognizes that, and then it's reinforced when they go talk to the highest potential recruits, and one of the first questions that recruits ask is, which technologies will I have access to? And how are you thinking about providing access to generative AI, and what's your roadmap for that? And I think that really emphasizes to them, hold on, we've got no option here. We're going to have to get immersed in this.
And make sure to listen, review, and subscribe to the Inside the Ice House podcast on your favorite podcast platform. Join Josh King every Monday for conversations with leaders, entrepreneurs, and visionaries. Scan the QR code right here to listen to the most recent episodes. Now, while opportunities CEOs see when it comes to AI dominates headlines as companies pursue growth strategies, it's only one part of the equation. According to Oliver Wyman Forum's new Growth Agenda survey, 75% of the CEOs participating in the study see growth opportunities in the competitive environment, including big strategic areas like M&A and disruptive new business models. According to the forum's research, 56% of participants selected a growth driver as their number one priority to increase shareholder value, compared to the only 44% for value drivers. Diving further into the CEO's emphasis on growth drivers, data from the Oliver Wyman Forum survey reveals that 3 of the 4 top priorities for increasing shareholder value in the next 1 or 2 years focus on growth. More than half of the participants, 55% actually, said a top priority for increasing shareholder value is organic investment in new revenue streams. 42% of CEOs participating in the survey selected revenue uplift, including pricing, customer loyalty, and other revenue drivers. And 41% of chief executives said that top priority for them increasing shareholder value is acquisitions. Now, just this week, we saw 2 rivals in the paper and packaging space. Smurfit Kappa and WestRock complete a merger and begin trading on the NYSE under the combined company's name, Smurfit WestRock, and ticker symbol SW. When plans for the merger were first announced back in September 2023, Tony Smurfit called this, quote, defining moment for the global packaging industry. He also said this, quote, Smurfit Westrock will be the go-to packaging partner of choice for customers, employees, and shareholders. We will have the leading assets, a unique global footprint in both paper and corrugated, a superb consumer specialty packaging business, significant synergies, and enhanced scale to deliver value in the short, medium, and long term. This past Monday, I had the opportunity to dive in this a little bit further with Smurfit CEO. Let's check it out.
Well, I think if you look at the coming together of our company, we bring great design for our customers. We've over 100,000 customers worldwide in 40 different countries. And so bringing together the knowledge of 50,000 employees from WestRock and 50,000 employees approximately from Smurfit Kappa, it has meant that we can give greater things for our customers. And also, being here in the United States really sends a real signal to them that we're here to stay, and we're a strong competitor for all of our competitors in the sector.
And with that being said, what would you say is your biggest priority or priorities for the rest of the year?
My biggest priority is to continue to grow the company, to bring together the two companies in a strong way, to make the cultures of the both companies come together, and to ensure that everybody feels a part of the Smurfit Westrock story, not the Smurfit Kappa story, not the WestRock story, but the Smurfit Westrock story.
Now, this isn't the only example of two rivals joining forces to create a larger market share in recent months. At the end of 2023, Caterpillar, a hybrid between a shipping and construction company that specializes in the transport and installation of foundations and offshore wind turbines, completed its merger with rival company Eneti in an effort to become the industry leader when it comes to offshore wind turbine and foundation installation space. Caterpillar trades on the NYSE under the ticker symbol CDLR, and its CEO, Michael Gleerup, didn't mince words to Allison Kosick when she asked about the merger and how it will elevate his companies to new levels.
It's really because we are the biggest in the world now. So we have a good foundation, both in the capital markets, being listed in Oslo and in New York now. We are the biggest company in the world in our space, and we are in a booming industry. So we are ready to take on the challenge and to help the industry and our clients, our partners, going forward to really make the world a better place.
Yeah, you are certainly setting yourself up for big growth. Can you talk me through some of that?
Yeah, but it is a growth industry. We are looking at tremendous growth in the industry. And in order to be a good supplier of clients in this industry, you need to continue to grow with them. And that is what we want to do. And for that to happen, you need to have the best partners also in the capital markets. And the New York Stock Exchange is certainly a very, very good partner to have, and we are so excited to be here.
What new projects is Caterpillar able to complete now following this merger and this fabulous listing on the New York Stock Exchange?
We are able to take on much more big and much more scalable projects, much more complex projects, because we have a much greater level of redundancy. And that is really remarkable. Just yesterday, we had the biggest project ever in our history, taking a final investment decision by Ørsted. It's a project that for us is between 500 and 700 million euros. So it's really a big project. And I think also as a bigger company, we are just able to take on more of that kind of projects.
The Oliver Wyman Forum's New Growth Agenda study also casts a light on another growth opportunity that leaders of NYSE-listed companies are focusing on: a changing consumer base. According to the data, 71% of participants see an opportunity to fuel growth when it comes to changing customer demographics and references. Earlier, we showed you that 55% of CEOs participating in the Oliver Wyman Forum survey cited organic investment in new revenue streams, a growth-based initiative, and capital efficiency and cash flow management, a value-based initiative as a top priority for increasing shareholder value in the next 1 to 2 years. However, CEOs participating in the study only got to choose one number one priority, and growth came out on top. 29% ranked investment in new revenue streams as their number one priority, compared with only 20% who opted for capital efficiency and cash flow management. The cruise industry is a prime example of where we're seeing this trend. According to the latest State of the Cruise Industry report put out by Cruise Lines International Association this past May, 27% of cruisers in the past 2 years have or who are new to cruise, an increase of 12% compared to the prior 2-year period. Norwegian Cruise Line, which trades here at the NYSE under ticker symbol NCLH, says that it's using data and consumer feedback in helping shape new experiences on its voyages. CEO Harry Sommer recently spoke to Judy Shaw more about this and its new 4-pillar strategy. Let's take a look.
Better, experience more, which we think is a call to action for our 41,000 crew members and staff around the world to really provide our guests with extraordinary vacation experiences. Past that, we hope that that message is going to resonate quite well with the 3 million people that travel on our cruises each year. So we're very excited. The actual strategy or the pillars that you mentioned that get behind that vision revolve around people, our product, our growth platform, and our performance. So I'll just go into each one for a couple of seconds. People really are the core of who we are. We have, as I mentioned before, 41,000 crew and staff around the world, and we are committed to investing them, developing them, and making them the best that they can possibly be. Our product speaks for itself, but we are committed, as I said before, to deliver exceptional vacations and to give guests experiences that they value and are willing to pay for. The next thing is about our growth platform. We announced a few weeks ago that we have 8 new ships that we've ordered for all 3 of our brands, Norwegian Cruise Line, Oceania Cruises, and Regent 7 Sea Cruises, that are all going to be brand new platforms and the largest ships that we ever built for those brands. These large platforms are going to allow us to have new amenities and experiences for our guests. We're especially looking to attract even more millennials and Gen Zs, and we think these new experiences are going to be perfect for them. And the larger platforms also allow us to become more efficient. We try to say that we have a balance between what we call return on experience and ROX and return on investment of ROI. And if we get that balance right, it leads to the 4th pillar, which is performance. Outstanding financial performance that we believe can unlock shareholder value.
Now, Harry, how does a data-driven approach provide better and more valuable experiences for your guests?
So listen, I think before, under the previous CEO, great guy, I love him, he was my mentor for 32 years, but he ran the company a lot by gut feel. And we are super committed to listening to what our guests have to say. In any given week, there are anywhere between 55 and 60,000 guests traveling on any of our 32 ships around the world. And we can ask them what they want, we can experiment, we can see what they ask for, we can see what they value, we can see what they're willing to pay for. And when we get that data, it can guide what we do moving forward. You know, it can be from everything, from menu selection, to entertainment, to the ports we visit, to the amenities that we offer on board the ship. The entire gamut of the product that we can provide is driven with what guests want, what they value, and they're willing to pay for.
While CEOs are seeing plenty of opportunity when it comes to growth opportunities, they also address some of their top concerns. 51% of CEOs surveyed said volatile inflation and interest rates are one of the top factors disrupting business today. And it's important to note, as we bring you some breaking news in the past hour, we're getting images right now of Lynn Martin with the executive team, John Romeo, CEO of the Oliver Wyman Forum, and he will be ringing the opening bell. We're seeing them make their way right now underneath the bell podium where they are going to sign the distinguished guest book. But back to my original thought, the Bureau of Labor Statistics announcing that consumer prices in June rose by 3% from a year ago. This just in this morning. And so joining me now to talk more about this is JD Durkin. He is the host at thepublic.com and contributor for CBS News. Good morning.
Good morning. Happy CPI Day.
Yes, happy CPI
Nerds
Day.
Nerds like us celebrate inflation prints. Here we are.
And you know, we're getting images right now. There's Lynn Martin, and there
I always
is
love this.
John
I don't mean to interrupt
Romeo.
from inflation, but like the behind the scenes look to see Lynn walk down the back stairway. I always think this is awesome because viewers at home never get to see what this is like.
No, and you know, while it is obviously an open trading floor, it's closed to the public, and so to get sort of an insider look as to what takes place here on the floor every single morning, sometimes multiple times a day when we have multiple IPOs, it's really cool. But you know, let's get into this a little bit more. So obviously, CPI numbers. What should investors be thinking about as this news just came out this morning?
Yeah, top line print for CPI a bit softer than expected, and we can't forget, Trinity, that's good news for for the central bank, who has indicated we've seen a softening in the labor market, and we want to see greater confidence. That's what Jay Powell and his colleagues say. We got to see greater confidence. Inflation's coming down to 2%. Now, that core CPI number, right in line with expectations. As much as we love CPI, tomorrow we get PPI or wholesale inflation. Those are important. The big dog to watch. PCE, we heard that again from Jay Powell, because he testified to the House of Representatives and the Senate down in Washington the last few days, and he said the other inflation readings are good. It's really PCE that's guiding our path forward on monetary policy.
But you know, the million-dollar question our viewers, I'm sure, want to know too, when are we going to see these rate cuts? I mean, how long are you going to keep on saying, oh, you know, later this year? I mean, still, we have not seen anything.
No, let's just say it again, later this year, maybe. I mean, right now it seems like if you look at the CME Group FedWatch tool, September now seems to kind of indicate that would be that last meeting before the November election. We got one coming up at the end of July, and then that crucial September meeting. But I think that PCE number at the end of the month is going to be really important. Trinity, if for whatever reason that PCE reading is hotter than expected, that is going to once again kind of kick that can down the proverbial road, would not give the central bank as much confidence to cut rates. So it's wait and see for Friday the 26th. But today we sit there, we've been asking this question for well over a year. The smart money seems to be on September pending future inflation data.
But what if we don't see it? What if we don't get a rate cut? I mean, it's a presidential election, a lot of things happening.
Absolutely.
I mean, what's going to happen?
Then we just don't get a rate cut before the election. Now that November meeting is actually 2 days after the election, or a day after. It's like around November 7th or so we'll get that decision. We get another one there in December. What's interesting is if you look back at the history of modern presidential elections, go back to 1980, every year outside of 2012 we've had a presidential cycle. The Fed has either raised rates or lowered rates, because the Fed at the time is responding to a shift in economic conditions, it's responding to a potential recession, or it's continuing its path of monetary policy. And that tells me the Fed has confidence that it knows its dual mandate. Elections be damned, it's going to do what it has to do in this particular case to make sure inflation's as close to 2% as possible.
And you've covered that extensively, you know, presidential elections, how it's going to impact markets. If we don't see a rate cut, we go through this election, how do you think the market's going to react?
Honestly, I think at this point, I've covered so many of these cycles for midterm and presidential cycles. I like investors will look for the silver lining no matter what the outcome of the election is. I think if it's a clean Republican sweep, they'll say, cool, maybe that means more tax cuts. If it's a Democratic sweep, please.
I don't mean to cut you off, but I do want to get this question in. We have about 30 seconds left. So last week, the Fed released its twice yearly monetary policy report. So what made this edition so interesting from your standpoint?
Yeah, they really stressed monetary policy independence, Fed independence, especially in an election year. The voices on Capitol Hill are very loud, and to be honest, members of Congress don't really understand monetary policy as well as people here on Wall Street. They will make accusations that the Fed might be trying to kind of tamper with the opinions of voters in an election year. But I think stressing Fed independence is important in that report. We'll continue to hear that from Fed officials.
Okay, great. And then besides inflation, what do you think are the biggest economic storylines right now?
Yeah, I mean, that's definitely the big one. I think for voters, they're looking at jobs, even if they feel more or less personally confident in their own situation. Jobs are really important. And then we've also seen, according to polling from voters, that the national debt is a big issue. I mean, that's something that members of Congress
I'd love to talk to you this more, but I'm getting word right now that we have to move on.
That's
Thank you so much for joining us right now.
See ya.
And I recently spoke with Patrick Young about the latest edition of his book and what readers should be mindful of when it comes to the fintech space in 2024. Let's take a look.
Capital Market Revolution was the synthesis of my understanding. I'd been working online since 1994 on the World Wide Wait, as it really was then, before it truly became the web. And I appreciated and understood how that was going to change the world of finance, because I was a derivatives trader. I could see how everything was going to change, from the floors being closed down, or at least changing the way that they worked, all the way through to how we would end up with digital assets and all manner of other things, changing the face of financial centers and the ways that we interacted every day, including with our bank.
What would you say are the biggest changes we're seeing in the fintech industry that you addressed in your book?
I think the biggest changes that we had was the way that the exchange became the dominant model of not just financial markets, but e-commerce as a whole. I mean, we don't realize or appreciate the fact that we all use Amazon, eBay, Uber, Lyft every day, and yet those are actually exchanges. Uber don't own any cars. They're just another independent platform matching buyers and sellers, albeit without the benign influence of the SEC.
And obviously the technology landscape is rapidly evolving, and we're seeing a lot of challenges but opportunities in this space. What would you say they are?
The endless number of opportunities around at the moment is, look at exchanges, look at the exchange model. We've seen an incredible consolidation, for example, the Intercontinental Exchange buying multiple exchanges, including the New York Stock Exchange. Yet at the bottom of that pyramid, I call it Young Pyramid of Exchanges, Young's Pyramid of Exchanges is expanding all the time because people are trading new artifacts. Some of them are digital assets, things like advertising slots. Some of them are new commodities that haven't been traded before. Think about this. I mean, I think it's really, really interesting altogether, Trinity. We do not have liquid, and there's a pun in this, markets in water the world over. We do not have major league markets in rice because of government subsidy. Sooner or later, we're going to see those being traded, just as we're used to seeing electricity and all forms of oil and gas being traded today.
And with the evolution of technology and AI implementation into business models around the world, how do you see the overall landscape changing in the next 25 years when it comes to fintech?
Two things. One is we'll probably have a lot of the same brands that we had 25 years ago or that we have today. You look at it, what are the most expensive brands in finance? Things like the New York Stock Exchange, renowned the world over. Those aren't going to go away. However, what is actually a bank going to look like? I think it's going to be much more of a technological interaction. It's going to be much more automated. We're going to see the whole way that, say, for example, mortgage processing is going to change uniformly across the board from the United States around the world. People are going to be finding a whole new way to interact because let's face it, the universe of today, we're seeing children being born today that are probably never going to have driving licenses. They're probably, when the time they get to 19 or 20, they're never actually going to deal with a bank branch. So those are going to be the things as we move more increasingly into the virtual, that the world is going to be one that is increasingly online. But the most important point to bear in mind is AI can help us process that data, but humans, face-to-face interaction is going to remain vital, and that's why the New York Stock Exchange has such a valid and key role to play in finance to this day and to 25 years from now.
Another topic that you address quite frequently in your podcast and in your book is crypto. Let's talk more about this, especially because in the past several months we've seen Bitcoin spot ETFs begin trading on U.S. exchanges and saw the latest Bitcoin halving in April. So what do you think are the biggest trends right now we're seeing in this space? What should we be on the lookout for?
25 years, think about it this way. Bitcoin is the Model T Ford of the new age technology of cryptocurrency. So therefore, it's going to be an enthusiast-driven thing. It's going to be like Morse code, or indeed people who prefer to drive Model T Fords as opposed to whatever you're driving today on the road, even though the Model T Ford is 95% of the DNA of actually what is a modern car. The way of doing things in a digital format is what's important. I'm from the bold generation, born analog, living digitally. And that with the born digital generation is where we're going to see an incredible change in things. I don't get terribly excited about Bitcoin per se. What I do find interesting though is cryptocurrency per se must become better regulated. It must become part of the financial infrastructure of many more of the ways of legacy doing of things and dealings. And that's something which is quite controversial because there's some, I think, slightly wrong-headed belief that somehow or other crypto can do it in its own way without the SEC, without all of the modern structures that we have for regulating other markets. But at the same time, are we going to be in a position where we talked about in Capital Market Revolution, where essentially you would open your wallet, a digital wallet, we didn't even think about the fact it was going to be on your smartphone. You'll open your digital wallet on your smartphone, that's all your assets, all your liabilities. You can put your money overnight into some sort of a crypto asset for the future. Those are all coming things. The bit that's a problem for Bitcoin is it's the first ever development in the world of fintech which has actually been more expensive and not necessarily instantly more scalable. And that's the problem I have with it. For every other thing that has worked in fintech, it's worked because it's been a heck of a lot cheaper and it's a heck of a lot more scalable and easier to use. And at the moment, cryptocurrency is clunky to use and the nerds are keeping it that way. When that interface changes, then I think you will see much broader adoption of the digital asset universe. When it's cheaper to deal in, you'll see much broader adoption of the digital assets universe. And indeed, when it becomes truly scalable, because for all of the talk about Bitcoin being a wonderful and great money, it's far too volatile as an underlying price, and it does not really scale terribly well to being delivered in the way that actually, simple dollar bills and the smart card you have in your wallet can be used at the MTA or even your telephone.
I I just ran into Mr. John Tuttle, Vice Chair of NYSE Institute here at the New York Stock Exchange. What's going on, John? I mean, let's Oliver Wyman's here ringing the opening bell.
Well, great to be on NYSE TV again this week. It's an exciting morning. We just launched our CEO survey that we partnered with Oliver Wyman on. This idea came about in January. We had a meeting with our teams. We said, we have excellent relationships with our CEOs. We have the best community of companies on earth. You have some of the greatest minds and cognitive scientists. How do we come together and say, what's top of mind for CEOs? Not just sentiment, how do they feel about the market, the weather, whatever it may be, but how are they investing? How are they allocating capital? How are they thinking about their workforces? And today we're launching the report. We're excited as can be. We've got some great NYSE listed CEOs up here to celebrate it too.
We are actually going to tune in right now to listen to that opening bell. So thank you so much for joining us quickly.
Do it, Trinity.
All right, let's tune into the bell. We'll be right back. It is official that U.S. equity markets are now open. Stocks are trading. But joining me now is Jay Woods. He is the Chief Global Strategist at Freedom Capital Market. Trading just started, Jay.
Opening to record highs. What could be better?
I mean, what could be better? We love to see green on the screen. I mean, it's been a very, very busy day, especially with the CPI data coming out this morning. And so walk us through that. Walk us through like the biggest takeaways right now, what investors are anticipating and how they're responding.
Yeah, well, the CPI has been one of the indicators that's caused the most volatility, the most action back here on the floor. And you can hear a little bit of a buzz. The traders are a little more active than normal. And this reading was very important to us because Fed Chairman Powell, he's been testifying in Washington, giving us an idea that we may be on the path to finally cutting at that September meeting. This pretty much solidifies it. There's an 85% chance of a rate cut come September because this data came in cooler than anticipated, 3.0% versus 3.1%, and the trends continue to slow on the inflationary front. So for us, this is positive, and then the market obviously sees it that way as well. Watch the small caps. The Russell 2000's been lagging. We're finally seeing a nice bid there. A lot to catch up for those small caps, and this is a very positive number for them as well.
And you know, as you mentioned, there's more inflation data on tap this week, and you know, the wholesale price data also comes out tomorrow. How are investors going to respond to this?
Yeah, we're watching that. It's not as important as the CPI, the PPI, and then the PCE, the Fed's favorite inflationary number. What we're actually watching are individual earnings kick up as well. We got two today. Delta and Pepsi both reported. They're trading a little lower, some guidance that has a few people worried. So we want to hear from the CEOs, these big companies, what they're seeing. Tech companies continue to do well, but is that broadening out to other sectors like the staples, like the transports? Right now, not the greatest start to earnings season. It's not too bad. JP Morgan, the financials start tomorrow. That's what we'll be watching more than some of these other inflationary data points, which are important, but won't steal the headlines from earnings, that's for sure.
You know, you mentioned big banks. Obviously, that data is coming out tomorrow. But what other market movers are happening right now, like across all sectors as we kick off earnings season?
Yeah, I think what we want to follow are sectors. So right now, it's the financials. JP Morgan is just one of many. Next week is a big bank week. Financials are the third best sector so far year to date, up 10%. And here's a fun fact for you. When they move, the XLF, which covers the financial sector, it's been around for 25 years. It's only up 15 of 25 years. Not the greatest track record. When it's up an average of 21%. So there's more room to run in the financials. We'll see how they kick us off. And then we're going to follow healthcare. We're going to follow utilities. It's going to be, the next 3 weeks are going to be a little busier than what we've had since that 4th of July holiday, so it's good to get some action down here.
What would you say the next big catalyst is for the market?
And then we're watching that Fed meeting July 31st. We got a PCE number before that. It's about interest rates. We've been anticipating a cut for the better part of 6 months now. It's been exactly a year since the Fed has done anything with rates. They raised us a 1/4 point a year ago next week, so we'll have that anniversary. And now, could they cut us a 1/4 point maybe in July? Powell usually telegraphs that, so there's going to be a lot of Fed speak over the next week. We'll be watching that. We'll be watching earnings. We'll be watching the PCE. So action is back, and that's exciting for us down here.
Action is back, and it's packed here on the floor, as you could probably tell behind us. But thank you so much, Jay, for joining me on the show today.
Yep, great to be here. Thanks.
All right, see you later. Now, the New York Stock Exchange has had plenty to celebrate in 2024, including its 232nd birthday, this past May. NYSE curator of our archives, Anna Mello, explains how the exchange has used technology to lead over 2 centuries of change. Let's take a look.
This year, the New York Stock Exchange is celebrating our 232nd anniversary on May 17th. The history of the exchange has always been a history of technological disruption. As capital is raised, shares are traded, and information is disseminated with the public, it is always using the most advanced technology of the time for over 2 centuries. When the New York Stock Exchange was founded in 1792, trading looked far different than it does today. We operated as a call market, which looked a lot like an auction. The president of the exchange would stand at the front of a room, and he would call the name of individual securities to be traded in increments of 5 minutes each. Asking price, actual price, and final price were all recorded in a quotation book just like this one, dating from 1819. The stock ticker, the first market-specific invention and arguably the technology most closely associated with the markets, was introduced to the New York Stock Exchange in 1867. Up until the 1990s, when traders adopted the internet, stock tickers provided vital market information to businesses and news organizations. A stock ticker is essentially a specialized telegraph that prints an alphanumeric symbol onto a piece of ticker tape, alongside the current price of a company's stock. This particular example is one of the earliest stock tickers used at the New York Stock Exchange, dating from 1880. It was able to print 250 characters a minute. The New York Stock Exchange nickname of the Big Board derives from our original broker paging system, the Annunciator Board, installed in this building in 1903. Each of these Annunciator numbers was painted with an individual member's broker number and arranged on either side of the trading floor in racks 800 square feet each. With the press of a button, one of these flaps could be flipped over, alerting a broker on the floor to the fact that he had an order waiting with his clerk. These were eventually replaced by an electronic paging system. The original high-speed data network of the New York Stock Exchange was installed in our current building in 1903, a pneumatic tube system that sent trade tickets all around the exchange. Executed trades were written or typed out onto a slip of paper and then inserted into this tube called a widget. The widget was then placed inside one of these terminals, each labeled with its destination, and then a puff of compressed air from the compressor down in the basement would send it off to its destination in 15 seconds every time. By 1979, the information age was fully underway, and in order to remain cutting edge and relevant, the New York Stock Exchange had to innovate itself. From 1979 to 1981, on the floor of the exchange, over 15,000 pounds of cathode ray tube television and computer screens were installed, all supported by our superstructure. During the renovation, not a single day of trading was lost. All of the construction went on behind the scenes, and new trading posts were installed over the weekends. Innovations and advancements in technology such as this allowed the New York Stock Exchange to achieve a market cap of over $1 trillion by 1980. Handheld touchscreen computers have been used on the floor of the New York Stock Exchange since the mid-1990s. This Epson handheld computer from 1997 ran the card reader replacement tool, which allowed staff reporters on the floor of the New York Stock Exchange to report outcry trades on the tape. Advancements in technology and increases in computing power such as this facilitated the New York Stock Exchange to achieving our first 1 billion shares day on October 28, 1997. Brokers and designated market makers on the floor of the New York Stock Exchange utilize an advanced high-speed data network and state-of-the-art technology to execute over 1 billion shares a day. Our new integrated trading technology platform, NYSE Pillar, was completed in 2023 and allows member firms to connect to all NYSE equities and options markets. pillar improves efficiency while reducing complexity, while enhancing consistency and performance for all of our customers. What will the future hold? We are excited to see what's coming over the next 200-odd years as technology marches forever onwards and upwards.
Joining me now is Kava CEO Brett Schulman. Good morning.
Good morning.
It's great to have you, and thanks for joining us on the show this morning.
Yeah, thanks for having me.
So let's talk more about the reports, the findings that just came out. So what stood out to you most about this survey?
Well, I think one general theme is that the world is more fluid and acceleration is accelerating. So as leaders, how do you adapt? How do you act with agility? And then kind of double clicking on it, geopolitical challenges, as well as human capital and people's purpose in going to work. And then lastly, AI, and how are you addressing AI and incorporating it into your organization, your business?
And let's talk about that implementation. How are you implementing the findings from this survey, this report, into your business model?
Yeah, well, something we've done historically at Kava since our very early days is really invest in our team. We think that ultimately creates long-term shareholder value. But on the AI front, something we talked about last quarter is our Connected Kitchen initiative. So how we're using AI to help our teams operate our restaurants more efficiently and effectively. Things like predictive prep, predictive cook, labor scheduling, leveraging AI capabilities.
And you know, inflation is at the forefront of discussions around the world, especially here on Wall Street. How would you say that it's impacting your business model, if any, and its customers, and how are you continuing to garner success?
Well, we've focused not only investing in our team members, but investing in our guests. So if you think about the time period from the end of 2019 to the end of 2023, at Kava, we raised prices about 12% over that time period. CPI grew at 18%. The Labor Department has noted that fast food has raised their prices almost 30%. So we've really been able to enhance that total value proposition, work on behalf of our guests, and really drive that great Mediterranean meal for them.
Oh, it is a great Mediterranean meal, too. I eat it like all the time. Thank you so much, Brett, for joining me today.
Thanks for having me.
All right, I'll see you later. Now we're going to throw it to a few live looks up the floor, and we'll be right back. Joining me now is Takeda CEO Christoph Weber. Good morning, Christoph.
Good morning. Pleasure to be here.
It's a pleasure to have you. And let's talk about the findings in the new growth agenda study. What would you say were the biggest takeaways or things that stood out to you?
I think it was a very strong confirming of what we are seeing, the trends. When you look at the impact of AI, every company is looking for growth and the geopolitical environment that we are dealing with.
How would you say that you're implementing these growth strategies into Kateda's agenda?
Well, we are a global company, so geopolitics matters a lot, so that's very, very clear. And we are also investing very much in technology and AI. It is transforming the way we do research, development, manufacturing, also the way we are interacting with our customers.
And as the biopharmaceutical industry is constantly evolving, obviously it poses new challenges, but new opportunities. Tell me exactly from where you stand, how is your company navigating through this ever-evolving landscape?
Yeah, sure. I mean, the new opportunities are, of course, in our case, new medicines. Can we deliver the new medicines which will change the life of patients? But when you think about AI, for example, we have opportunities in our cost efficiency, so we can be much more efficient in what we do. But it will also create opportunities with new revenue opportunities, and that's also very exciting.
Very exciting work. Thank you so much, Christoph. Take care. All right, we are going to throw it to a quick message from the NYSE, and we'll be right back. Joining me now is PSE&G CEO Ralph LaRosa. Good morning, Ralph.
Good morning. Thanks for having us.
Absolutely. It's such a pleasure to have you. So let's talk about this study. What would you say were the biggest things that stood out to you?
Yeah, there were basically three things that stood out to me. One was the geopolitical risks that were identified by most of the CEOs in the survey. I think that is something that we're seeing across all industries. Us in the utility industry really been focused on supply chain and where we're able to get some of the supplies that come from overseas and how those have been disrupted, whether from the pandemic or challenges that we now have with some of the geopolitical issues that are going on. That was the first one that stood out. The second one was really the workforce and how many companies are having challenges on that front. For us at a utility, we haven't had the same turnover rates that others have had, so we really have to stay focused on that and make sure that our workforce is engaged, and we've broken down the silos that happen sometimes between management and unions. And then the final piece is AI, and how important that's really become for most of the companies that were engaged in this survey. Our role there is really to make sure that we are all providing the power that's needed to make sure that those AI data centers can all be up and running and that they have that reliability and clean energy that they're focused on.
That's amazing. And you know, it sounds like you're doing a lot to really implement these growth strategies into your business model. Has there been any one area that has been more challenging than others? And if so, how did you overcome that?
Yeah, we really been focused on aligning with the public policy, whether it be at the federal level or at the state level. And as a result of that, we've been able to move pretty smoothly. It's all about making sure that we have affordable energy for our customers, it's reliable, and they have access to as many clean resources as they possibly can. So by focusing on those three core values, we've been able to work through any political changes that might be taking place.
And you know, let's talk about the data, that investor data that just came out earlier this week, really highlighted your company's efforts to providing clean energy. What sort of opportunities right now are you seeing in this space? How are you going about executing efficiently and effectively?
Yeah, so there's two real main focuses. One is the upgrades that we're making to the core infrastructure, whether it be our gas infrastructure, where we're replacing old cast iron mains, reducing leaks that might take place on that system, upgrading our distribution system so that we can provide clean power, again, more reliably than we have in the past. But it's really a big focus on energy efficiency, helping customers use less power. Might sound strange for a utility to be talking about that, but we're incented to do that. We've worked with our regulators to set that up, and we're really trying to help people find ways to reduce usage in their homes.
Amazing work. Well, thank you so much for joining me today.
Thanks for having us.
Now we're going to toss it to a quick word from the NYSE, and we'll be right back. John Romeo, CEO of the Oliver Wyman Forum, is joining me now. Good morning.
Good morning. Thanks, Trinity.
I mean, this study was very, very in-depth, impressive. What would you say were the biggest takeaways for you? Anything that stood out specifically from your vantage point?
Listen, we're living in an extraordinary time. We've got a fragmented world, a more event-driven world. The change just keeps coming and coming and coming. The business environment is probably the most uncertain, yet the most promising we've seen in memory. And what came through in the report really loud and clear is that mix of the uncertainty and the promise. On the one hand, you've got 54% of CEOs are concerned about government interference, regulation, protectionism, subsidies, and how it affects their business and changes the playing field. But they're not getting overly focused on that. They've really pivoted and are doubling down on growth, looking at the opportunity that comes out of that. And AI is just the most obvious manifestation of that right now.
Yeah, absolutely. I mean, it's at the forefront of conversations on Wall Street and around the world. But talk to me about what went into the decision-making process, why you chose to partner with the NYSE and its listed companies for this study.
Well, the New York Stock Exchange has an incredible community of corporate America. And we wanted to talk not just about sentiment changes, what's happening to interest rates or the economy. We wanted to get into the real business decisions, how CEOs are responding to that, how they're navigating the environmental, the political, the economic, the technological challenges, and the real hard business decisions they're taking. Where are you making investments? Where are you pulling back from? Where are you really trying to double down for growth?
And you hosted the roundtable discussion this morning. Talk to me about how that went, what the key findings were through that discussion, and how it compared to the survey.
We had a great community of CEOs, and they were really engaged. The themes from the report resonated, but what it allowed us to do was to dig deeper. Because the survey is a point-in-time study. It's the start of a longer conversation. And as we got into the detail, it was digging into AI and whether people were investing for efficiency or for new streams of growth. There's a lot of talk around sustainability, how it's changing decision-making, how it's affecting business priorities, but everyone said it's really driving force in their business. And the biggest thing we got stuck into was investment. And a few years ago, people were worried about the environment, preparing for a recession. Now what we saw was a real level of optimism around long-term, multi-year investments. Really, where are you taking your bets?
And you know, merger volume has really subdued in recent years, but the CEOs ranked acquisitions among their top priorities. What do you take away from that?
3/4 saw it as their top investment opportunity. It was expanding growth. Given the level of change, they wanted to dig in. They want to take advantage of that. The risk, the dislocation that's happening creates tremendous opportunities to add capabilities and to build. And I think CEOs are looking at that. They're looking around and saying, I have to be on the front foot and take advantage of that. And the M&A is a great example and a great proxy for the level of animal spirits. And we're just seeing huge optimism from the CEOs out there.
Thank you so much for joining me today. It was great speaking with you.
Thank you. It was a pleasure.
Now we're going to take a look around some live shots on the floor, and we'll be right back. Nick Studer, CEO of Oliver Wyman, is joining me now. Hello and good morning.
Hi, Trinity. It's great to see you. Great to be here.
It's great to have you guys. I mean, the findings from this study were very impressive. Very, very key takeaways there. But, you know, talk to us why about you decided to move forward with this study, the significance in being partners with the NYSE, and the most notable takeaways for you.
Yeah. So Oliver Wyman works with CEOs of some of the world's largest companies, helping them solve their big issues, really. And, you know, New York Stock Exchange members are those companies. This is our client base. And we wanted to work together to really gather a sense of where CEOs are now. CEOs specifically, not their teams, the people who have to build this bridge between the inside of companies and the external markets. And for me, the takeaways, maybe two key ones. Firstly, CEOs are fundamentally optimistic. So you see a bunch of things which are some of the big challenges for the world, how AI will affect the workforce, how climate change will affect things. The CEOs see this predominantly as opportunities, not as threats. Whenever do 95% of people agree, and that's the percentage of CEOs that felt that AI will be an opportunity for their business rather than a threat. And then I think the second observation for me, which resonates with me in my own CEO role, is trying to balance these different issues between investing for resilience, investing for organic growth, but also being capital efficient and being cost efficient. It's really hard to get that sort of trilemma balanced.
Absolutely, and through your experience in speaking to the other CEOs, being here, part of the roundtable at the NYSE, what is your sense from other leaders in the industries? Do you find them comparable to the survey findings?
Very much so. So we had a set of CEOs around the table representing the cruise industry, representing the restaurant industry, chemicals, pharma, energy, a whole cross-section. And you might think they'd have very, very different issues. And indeed, there are different emphases. But I think all of them face that same set of challenges. How to balance what your workforce needs with what the political environment is telling you. How to manage your geopolitical challenges across countries. And in an environment where we see opportunities for growth, but we can't take profitability for granted. So yeah, I think those resonated across all the sectors.
And now, learning about all of these new findings, this research, how would you say that this survey resonates with you personally?
Yeah, so there was a comment in the survey, an F. Scott Fitzgerald quote, which said something like the sign of an able mind is being able to hold two contradictory views at the same time and still function. I'm not sure I manage to do that every day, but the contradictory views I feel all the time. So it was actually nice to be around the table with a bunch of CEOs struggling with these same trade-offs. I don't think we get to make clear choices anymore as CEOs. It's more about managing polarities, managing balance. So actually it felt pretty good. That resonated a lot with me.
Oh, I love that. Well, thank you so much for joining me today.
Thank you for having me. It's been great.
It's been great. All right, we're going to toss it now to a quick word from our parent company, ICE, and we'll be right back.
Climate events are rising in frequency and severity. Increasingly, climate risk impacts investment risk. To help integrate these risks, the ICE Climate Transition Analytics tool generates analytics to identify, assess, and report climate factors in portfolios and loan books. Upload a portfolio to generate an array of climate analytics. Access carbon footprinting analysis, avoided emissions data, and Scope 3 emissions data. Conduct net zero analysis. Compare portfolio and benchmark pathways. Check portfolio's progress towards stated decarbonization targets. Conduct scenario alignment. Analyze portfolio implied temperature rise score and assess trajectory against chosen climate scenarios. Calculate temperature scores using the science-based Targets Initiative aligned approach. Access stranded assets data and analyze fossil fuel reserves footprint and country-level exposure. Generate and customize powerful reports, including TCFD-aligned reports that can help you meet your regulatory and stakeholder requirements. Access ICE's Climate Transition Analytics and more today.
Anna Kriachich, partner at Oliver Wyman and COO of the Oliver Wyman Forum, is joining me now. Good morning.
Morning. How are you?
I'm good. I mean, it's great. We have a great crowd here. You guys are here.
Great day. Great opening day.
It is a great opening day, but I want to talk to you more about this report. It's called the New Growth Agenda. So what would you say the new is about? And I mean, shouldn't we expect CEOs to, prioritize growth?
Yeah, I mean, I think what's new is that we have a growth agenda in a very different, challenging environment, right? The trade winds have completely shifted over what we were dealing with over the last few decades. The economic environment in the U.S. certainly is strong, but it's nothing like the roaring 90s. And then, money is more expensive, even though we got some more good news this morning. AI, the transformation and the hype and all of the investment that's happening, a lot of difficult decisions to make there, and we're seeing differences between how large companies versus mid-cap or smaller companies are dealing with that. And then, of course, all of the geopolitical shifts where, you're seeing increased protectionism, you're seeing some of the playing fields shifting, and companies really having to realign their supply chain. So yes, CEOs have always had to focus on growth, but it's a very different environment. And what we're seeing them do now is, focus both on all of the kind of operating efficiency side, but have a lot of optimism around how to drive new growth, how to drive new revenue streams, and balancing that overall.
And, on the note of optimism, they were hugely optimistic about the growth of AI, the implementation of AI as it's at the forefront of so many different conversations. But why do you think that is?
The optimism around AI. I think they see it as another, not just big growth driver, but another way of dealing with some real problems that aren't just, cost cutting, which is what I think, many theorized at the beginning. We had a roundtable conversation this morning. Many of the industry CEOs have real challenges in finding the talent that they need. There are simply, one mentioned there's simply not enough accountants in Miami for what they need. And so what they're trying to do with AI is not just drive operating efficiencies for the sake of them, but really fill some gaps where we cannot, provide them with the resources that we have.
Given the results of the survey, how do you think from an investment standpoint, how should investors approach AI? I have to ask you the investment question. We are at the exchange.
We are at the exchange. Why don't I give you a personal, since I'm not a financial advisor, I'll give you a personal response based on, what I certainly saw in the 90s. So if in the 90s you had, made a bet that, on Ask Jeeves or Google or any of the search engines, you probably would have been wrong. 98% of the value went to Google. There were a gazillion search engines at the time. We're kind of in that early phase where we don't really know who the players are that are going to be successful with AI, but we know the infrastructure that's needed to power AI. We know the energy requirements, we know the data center requirements. And so, I think right now there are only some knowns that we can think about from an investment perspective and a lot of unknowns if you're willing to play the longer term game.
And CEOs, they're seeing a lot of opportunity when it comes to changing the customer demographic. So how do you read this?
Yeah, look, we've seen massive changes in customer demographics, especially coming out of COVID, because people were starting to change their behavior. They were valuing different things. They had different preferences. One CEO mentioned, I'm in the business of happiness. Lots of people want experiences. And that's absolutely true. But I think about two big groupings, particularly generationally. One is Gen Z, massive number of them entering the workforce and in the workforce, continuing to be a bigger player on the consumer side. And then what I call the silver economy, which is really people over 50. In the US, they're 37% of the US population. They spend 57 cents of every dollar. Both are incredibly important. And so, trying to understand them a little bit more deeply, it was very positive for me to see that it was one of the top 3 things that CEOs are prioritizing, because I think the potential around the growth and the AI experience is really creating very seamless customer experiences with, the changes underway.
A lot of important information right there. Thank you so much, Anna.
Thank you. Lovely to be here.
Now we're going to take a few more looks around the floor, and we'll be right back. James Warwick Alexander, partner at Oliver Wyman, is joining me now to talk more about the survey. Good morning.
Thank you for having me, Trinity.
I want to talk more about this finding. Okay, so the survey finds that CEOs are looking to break down silos and build more unified companies. So what is your take on this, and what challenges do you foresee in that sort of implementation?
Yes, the reality is it's really hard to do. You're asking people to change their way of working and to evolve the culture of companies. And that's not for the faint of heart. So what we find is that from our research, there are 3 key things that CEOs need to focus their attention on. The first one is, what's in it for me? Helping employees see that this will help to improve how they serve customers and how they can progress in their careers. Second point is to communicate. Show the shared success. And then the third one is to invest in developing the skills that people need to have in order to be able to perform the different roles that CEOs are expecting their teams to be able to do.
You know, the survey puts a spotlight on the geopolitical risks that we're seeing out there. So talk to me from your vantage point. What are you seeing on the ground that could impact supply chains?
So let me give you 2 stats from our report. Number one, 60% of companies are reducing exposure to higher risk regions. So you're already seeing a shift in supply chains. But at the same time, only 16% of these companies are reshoring operations domestically. And so what that's saying is that it's not that globalization is dead, but rather that supply chains are being rewired such that companies are looking to have their operations in countries that are more geopolitically aligned with their home office, whereas in the past it was more about driving efficient operating models.
What are other things that companies could be doing to get ahead of that geopolitical risk?
So what we're seeing is that, especially among larger companies that have global footprints, you've got 50% of companies right now who are investing in doing scenario planning and exercise to see what could happen and how can they react. The other thing I thought was quite interesting from our research, 25% of companies are actually hiring geopolitical experts on staff to be able to improve their ability to plan and to prepare for what the unknown could bring to them.
A lot of key takeaways right there. Thank you so much for joining us on the show today.
Thank you very much.
All right, that just about does it for us here at the New York Stock Exchange. I'm Trinity Chavez, and from all of us at NYSE TV Live, thank you for watching, and we'll see you next time.
In life, I'm reminded that it's not about the destination, it is truly about the journey.
My pleasure to greet you today from the center of the U.S. capital markets here at the New York Stock Exchange.
I want to just take a minute and not just talk to the people that are in the room, but I want to speak to the rest of the team around the globe. These are people that made this happen, and I know that there is no way we would be here if it wasn't for you.
Everyone at Flutter is proud to join such a distinguished list of companies on this great stock exchange.
Not many people get to do something big in this world, and we get to do something truly special.
This is such a wonderful place to both look back and look forward. Look how far we have come. I'm so optimistic about what lies ahead. It has been a privilege to be with you.